Imagine a world where your employer quietly covered your bills for life. That was normal for many workers across America about 50 years ago. Loyal employees expected a steady monthly check after decades of consistent service. Today, that promise has mostly faded, leaving workers responsible for their own futures. We are living through one of the largest financial shifts in modern history. This story begins with a small adjustment buried inside an obscure tax rule. It eventually reshaped how retirement security and wealth responsibilities were distributed. Pensions once formed the sturdy backbone of the American middle-class lifestyle. Companies used these plans to keep skilled workers committed for many years. You offered loyalty, and the firm promised dependable income after retirement. Experts called this arrangement a defined benefit plan with predictable long-term obligations. The math stayed simple because the company handled investments and absorbed market shocks. Workers focused on their roles without worrying about rates, fees, or stock picks. The deal was clear: work hard today and receive stability during retirement years. Everything began shifting during the late 1970s as inflation squeezed corporate balance sheets. Businesses searched urgently for ways to reduce costs while protecting reported profits. In 1978, consultant Ted Benna studied a new section inside recent tax legislation. He noticed a clause labeled 401(k) that few executives fully understood then. Originally, the rule targeted bonus deferrals for high-level corporate leadership teams. Benna realized regular employees could also use it to save pre-tax income. He launched one of the first plans allowing workers to invest through payroll deductions. This marked a major shift in how people viewed responsibility for retirement savings. Tax advantages suddenly became the new centerpiece of long-term financial planning. Few realized a global change in incentives had quietly begun reshaping workplaces. Corporate leaders soon recognized an opportunity to reduce expensive pension liabilities. By adopting new plans, companies transferred market risk directly onto individual employees. If markets dropped, the firm no longer carried the same long-term burden. This change helped corporations report stronger earnings and higher valuations to investors. Wall Street welcomed the influx as retirement accounts generated steady management fees. Investment firms began overseeing trillions as public savings flowed into diversified funds. The transition started slowly, then accelerated as major employers froze legacy pensions. New hires were told the updated system offered flexibility for changing careers. Portability sounded attractive for a workforce expecting to switch roles multiple times. However, it also meant each person now carried full responsibility for retirement outcomes. The model depends on consistent decisions made carefully over 30 or 40 years. Most people struggle to prioritize distant needs over immediate spending temptations. These accounts demand discipline, regular contributions, and patience through volatile markets. Participants must choose funds wisely and resist withdrawing balances during stressful downturns. Even small mistakes early can significantly reduce wealth decades later. Traditional pensions rarely required workers to monitor markets or understand complex fee structures. Today, many employees feel pressured to act like cautious portfolio managers. The burden of constant choice can overwhelm people already juggling demanding daily responsibilities. Large numbers of workers contribute too little and miss years of compounding growth. Employer matching often becomes the main incentive, keeping participation rates reasonably stable. During recessions, even those matches can shrink or disappear without much warning. This is where confidence in a secure retirement begins to quietly erode. The crisis in 2008 exposed how vulnerable market-based savings could become. Many near-retirement watched balances fall sharply and postponed plans for several years. A traditional pension would have delivered steadier income despite temporary market chaos. Instead, individuals carried losses personally while institutions continued collecting management fees. Despite setbacks, the migration away from pensions kept advancing across industries worldwide. Governments also favored systems that encouraged citizens to fund more of retirement privately. Not everyone, however, has enough surplus income to save consistently each month. Higher earners can contribute larger amounts and benefit more from tax advantages. Households living paycheck to paycheck often end up with minimal retirement reserves. Over time, this dynamic can widen gaps between financially secure families and struggling ones. Complex fee structures quietly reduce returns, especially when percentages compound across decades. Many account holders never review disclosures and underestimate how much they pay annually. Financial firms still earn revenue whether portfolios rise strongly or decline temporarily. You might ask why companies rarely restore traditional pensions for modern workforces. Global competition and volatile markets make long-term guarantees expensive for corporate balance sheets. Businesses prioritize flexibility, lower fixed costs, and predictable expenses across uncertain economic cycles. As a result, classic pensions are often viewed as relics from a slower era. Today, you effectively become the chief steward of your own retirement strategy. No employer is obligated to cover your expenses once you reach age 65. The responsibility feels heavy, yet disciplined habits can still produce strong long-term security. Start by understanding the system rewards consistency, patience, and low-cost investment choices. Education helps you avoid common traps that quietly drain returns over many years. Simple diversified funds with modest fees often outperform complicated strategies over long horizons. Track contributions regularly and increase savings rates whenever income grows or expenses fall. The old gold watch tradition faded, but opportunities to build personal wealth still exist. Every contribution you make today becomes a worker supporting your future lifestyle. Stay focused on controllable factors like savings rate, fees, diversification, and time in markets. Ignore daily noise and short-term headlines that tempt emotional decisions. Consistent habits practiced for decades usually matter more than chasing quick gains. The shift from pensions to accounts changed the social contract around retirement security. We moved from shared protection toward individual risk paired with potential personal rewards. Those who recognized the change early used tax advantages to accumulate meaningful wealth. Others waited for promises that disappeared and reached retirement with limited resources. Your future comfort depends on choices you begin making consistently starting today.